I'm seeing the targets with my own eyes. Fall in love, will you stay? I'm begging you for it. We're making up, and it's your way. 'Cause I'm closer to the borderline. The borderline. Fall in love, will you stay? I'm begging you for it. We're making up, and it's your way. 'Cause I'm closer to the borderline. The borderline.
Good evening. Welcome to our 20th CFA Society Forecast Dinner. And as you settle into your dinner, we will have a brief invocation, and then I'll be back at 6:50 to get started with the program. And so at this moment, I would like to invite Dr. Steve Jusely, Senior Pastor at Lakeland Presbyterian Church.
Let us pray together. Almighty God and Heavenly Father, we thank you for creating us. We thank you for sustaining us, and thank you for giving us life and breath and all things to us. And then giving us the responsibility and the privilege of managing with wisdom those things you've given to us. Thank you, Lord, for bringing us here tonight. We pray this evening that you would be pleased to bless this food to us, that you would nourish us, that you would sustain us. And God, empower those gathered here tonight to serve you and to serve other people for their good and for your glory. Lord, I offer up this prayer of blessing in the name of our covenant Lord. Amen.
noches, señores y señoras. Bienvenidos a la cena número 20 de la Sociedad de Mississippi. I knew that would get your attention. Welcome again. My name is Paula Nielsen. I am the president of the CFA Society of Mississippi and Northern Louisiana. If you're a first-time attendant, I hope that you enjoy the remarks on the investment landscape of our panel of experts. And if you are a repeat attendee, I really hope that you're having a good time visiting with old friends and that you have an evening full of interesting insights as you've been accustomed to. This is the premier event of any CFA society. And it is a very special day for us because we're celebrating our 20th forecast dinner. And yes. Because of that, I would like to invite you to travel to 20 years ago when one of our members, Roger Munz, had a vision. And his vision was to have the premier event of investment professionals and business leaders in Mississippi. With a lot of hard work and the support of some of our longstanding members, he was our first forecast dinner chair, and he planned our first forecast dinner back in 2004. It is no doubt that Roger is a key founding member of our most successful event, and an event that we have enjoyed over the years and that has allowed us to obtain the funding that we need to work in our initiatives through the year, and that has helped grow the CFA Society of Mississippi into the professional organization it is today. And so Roger Munz couldn't be here with us today, but he's watching us on the live stream. And so I would like for all of us to send our love and appreciation and to thank Roger for the work that he did for our society. And so I would like for all of us to give a round of applause to Roger Munz. And talking about our members, I'd love to see so many of our members here today and their broader networks. It is you and our audience that truly make this event exceptional, and we hope that you're enjoying your evening. And on the topic of instrumental for our society, I would really like to thank our sponsors. And the sponsors of our 20th forecast dinner are PGM Fixed Income, New Perspectives, John Hancock Investment Management, Northern Trust, Wade's Investment Management, Applied Finance, Loma Sales, Cure Asset Capital Management, Raymond James, Amundi Asset Management, First Eagle Investments, Wallach Beth, and Farm Bureau Insurance. Woo! But what is sponsorship for? It is our sponsors who really support our mission. And it is through sponsorship that we're able to support the new generation of finance professionals coming into the industry in Mississippi. Through sponsorship, we offer scholarships so that students are able to go through the CFA program. And we offer these throughout the universities in Mississippi. It also allows us to fund the CFA Society of Mississippi Award, which is given to a student that excels in finance and has a desire to pursue the CFA charter. We offer scholarships at numerous colleges and universities throughout the state. So today we will recognize this year's CFA Society of Mississippi Awards recipients. Please hold your applause until the end because we have so many names and amazing students to recognize. So if you're here in the audience, students, if you will please stand up to be recognized as I say your name. Abigail Lynn, Belhaven University. Jordan Dancel, Centenary College. Tyler Goad, Delta State University. Victoria Salazar, Jackson State University. Bernard Comey, Louisiana Tech University. Ashley McWilliams, Louisiana State University. Raj Agrawal, Millsaps College. Dario Rouvier, Mississippi College. Benjamin Cowley, Mississippi State University. Kiara Venable, Southern Mississippi University. Maren Egging, University of Mississippi. And now all of you may clap. Also, thanks to our sponsors and the amazing work of volunteers, we held our third ethics challenge. As the ethics chair, that being my role as part of the board of directors of the CFA Society, it is no doubt my favorite event. It was hosted at Millsaps College this year, and the other competing teams were Jackson State University and Louisiana Tech. It was a nail-biting finish. And Millsaps College won our ethics challenge. And the winning team is here today. Congratulations again to Peyton, Sebastiani, Rigoberto, Raj, and Graham. And of course, to their superstar professor, Dr. Ken Q. And I want to say this was a great event, not only for the students, but also to our members who joined us in celebrating the competing teams. We're already looking forward to the event that we're having later in the fall. And today we have prepared for you a very short video so you can get a glimpse of what the Ethics Challenge is like. So here is the video. Sponsors also allow us to support and provide awards for the teams participating in the CFA Institute Research Challenge. Not surprisingly, the Millsaps team won the first place at the Memphis Research Challenge this past Saturday. And we're so proud that they beat competitors such as Rhodes College and the University of Memphis. And last but not least, sponsorship allows us to offer 7 to 9 educational lunches per year. And these are free to members and only $10 for anybody else that wishes to attend. And this past year, thanks to Jonathan Pace, we had an incredible lineup of speakers and topics which helped our members stay up to date and satisfy their their continuing education requirement. On a personal note, it has been an honor to serve as the president of the CFA Society of Mississippi and Northern Louisiana. 12 years ago, I was a student guest and sat on these tables and was really impressed by the panel of experts. I thought it was so interesting and it really affirmed my career path. Later on, I was a recipient of the CFA Society of Mississippi Student Award, and then when I was really so motivated to go after the charter and do the program, the CFA Society of Mississippi provided the scholarships that I needed. So I barely paid anything to take the tests. After that, it was through the CFA Society of Mississippi that I met so many finance professionals, and now they are the ones that I consider my friends and are my colleagues. So it has been a great journey, and the CFA Society of Mississippi has been instrumental in getting me to where I am today. I wouldn't even have met the people that I work with today if it hadn't been for the CFA Society of Mississippi and all the work that we do through volunteering. It really has changed my life, and it has allowed me to have the career that I love. And so I want to say that it has also allowed me to travel all through the country and the world to meet peers and exchange ideas on how to better serve the members of the society, on how to better serve the industry, and ultimately the public at large. So I want to thank you all for the opportunity to serve. Of course, it takes a huge effort to put on the Forecast Dinner event. And being on the Forecast Dinner committee is one of the most challenging and yet rewarding jobs a CFA Society volunteer can have. It is immensely stressful for a person to take on the weight of the event on their shoulders, and that's why we pick the freshest member of the board to take on that job. And today, that is Andrew Hinnigus, and I'm sure that he cannot wait for the night to be over. Thank you, Andrew. You've done a great job. The rest of the Forecast Dinner Committee is Tony Edwards, Jerry Hinnigus, Dr. Walter Neely, Davis Bourne, and myself. And last but absolutely not least, I want to thank Mary Margaret Pritchard. He is our Employee of the Year for 5 years running. And as the responsibilities of the board increase and change, she is always there to keep us on track. We are immensely grateful for you, Mary Margaret. Thank you so much. So by now, I'm sure that you are all ready for a wine refill. And I'm also sure that you're ready to hear from our panel of experts. And so let me briefly introduce our panel. Joining us today in the panel, we have Dana Martin, Managing Director, ETF Trading Solutions at Wallach Beth Capital. Peter Strakolski, CFA CEO, Senior Portfolio Manager at Cure Asset Capital Management. Gabriela Santos, Managing Director and Chief Market Strategist for the Americas JP Morgan Asset Management. Now, for all your market outlook questions and more, I'm going to turn this event over to our moderator and Master of Ceremonies, David Caffrey. He's the Vice President and Client Advisor at JP Morgan. Dana serves registered investment advisors and bank and trust clients across the Southeast region of the United States, and as such, he's dedicated to empowering advisors by equipping them with intellectual capital to enhance their client interaction. He takes pride in helping advisors construct superior portfolios through JP Morgan Funds' comprehensive approach to asset management. Dave has over 2 decades of experience in the financial service industry and earned a JD from Storm College of Law at the University of Denver and a BA in Political Science from Boston College. Ladies and gentlemen, your Master of Ceremonies for the night, Dave Caffrey.
Wow. Thank you very much, Paula.
Thank
Pleasure.
you, Dave.
The dangers of a handshake when you start the night. So, give our panelists a second to get up on stage. Gabby, you sit here.
Dancing chair.
Yeah. Either, both are fine.
So,
Welcome again to the 20th annual CFA Society of Mississippi Forecast Dinner. It's an awesome event, and it's a great privilege for me to be here moderating this panel and operating as your Master of Ceremonies. So thank you for that. Before we start, I have 2 specific thank yous that I want to give, and then I want to tell one quick story about last year's dinner before we kick it off. So the first thank you is to the board, and I genuinely mean this. This is a big deal and a big honor for me and a privilege to be here tonight. So thank you for trusting me with the panel tonight. I really, really appreciate it. My second thank you is to the CFA community at large here in Mississippi. So I started working in Jackson a little over 10 years ago, and I knew exactly no one. And this community has been really critical to me getting to know and become friends with and do business with the financial services community in Jackson and in Mississippi in general. So thank you to all of you for that support, and I will be forever in your debt. And that kind of ties into the story that I wanted to tell you. So last year at the dinner, I was sitting with Jerry Henniges. Many of you know Jerry. We just talked about him. Jerry's sitting over there with his lovely wife, Allison. Jerry was one of the first people I met here in Jackson a little over 10 years ago. So this is my 9th forecast dinner this year, 9th. So I've been to a few. Anyway, Jerry introduced me to some of his colleagues at the first dinner that I came to. So last year I was sitting with Jerry at his table, right? So you can think of this as a story, maybe a public service announcement. So for any of you that are sitting with Jerry right now, if you have any bright ideas about things we might do next year at the dinner, you probably don't want to bring those up because you could end up in this spot next year if you're not careful. So, just the word to the wise. So here's our plan for tonight. We have 3 terrific experts with us. We'll start off and keep this conversational. Each of them will have some remarks on their areas of expertise. As we go through that, you can see I've got a notebook. I'm going to take some notes as we go, maybe have a few questions to follow up with them. You'll see on your table, there's also note cards. So I would encourage you to think the same way. If you hear them bring something up and you don't get enough information, write a question down. If we don't address something that you want to hear about, write it down. And what we'll do is at the end of these remarks, we'll gather those up and we'll ask the panel those questions. Does that work for everybody? Yeah? All right. I need a little audience participation. Yeah, we're good? Okay, cool. All right. So Paula stole my thunder a little bit on some of the introductions. So let me elaborate a little bit on everybody's background. So to my right, my colleague, Gabriela Santos, as Paula mentioned, she's a managing director and chief market strategist for the Americas for JP Morgan Asset Management. So what does that mean? That means she shares insights on the global economy and markets with our institutional and retail clients. It also means she's responsible for developing the Guide to the Markets, the Guide to the Markets China, and the Guide to the Markets Latin America. Prior to working at JP Morgan, she worked at HSBC Private Bank in Switzerland, Mexico, and Singapore. And so maybe not surprisingly, an interesting fact about Gabby is she is fluent in French, Spanish, English, and Portuguese.
English as well, yes.
Did I not say English?
No, you did.
Yeah, I did. Okay, cool. And I'm going to start off with, I asked everybody for a fun fact about them that I could share with the audience, and Gabby Gabby's, I think, number one. Pete's pretty good too. Yours is nice, but it's not as funny.
nice, yeah.
But
It's fine.
So Gabby's fun fact is she once had a shot of tequila with Pitbull in Miami.
That's awesome.
I've heard,
At a JP Morgan dinner, by the way.
okay. So that's probably a good story to ask her about later if you get a chance to chat with her, okay? All right, so moving to my left, to Pete Strelkowski. Pete's CFA, he's the CEO and Senior Portfolio Manager at Curacet Capital. So what does that mean? Curacet's a bond manager, a fixed income asset management firm. Prior to founding Curacet in 2021, Pete was a fixed income manager, a bond manager at Oppenheimer Funds, covering the broad spectrum of fixed income asset classes. Pete graduated from, I forgot to, all right, I'm skipping schools, I forgot to do schools.
Skip school, especially mine.
Fun fact about Pete, he owns a small cattle farm, which means it's really easy for him to spot BS. So, that was good, right?
It's good.
That was pretty good. Not as good as a shot of tequila with Pitbull, but pretty good, right? All right, so last but not least, all the way to my left, Dana Martin. Dana's a Managing Director of ETF and Trading Solutions for Wallach Beth Capital. So what does that mean? So Dana works with their sales, he runs their sales and trading teams, and they work with institutions like us, like Curacet, like JP Morgan, like many of the other sponsors here, to help them facilitate the complex transactions associated with their portfolios and ETFs. And we'll talk about ETFs in just a second. So prior to Wallach Beth, Dana was at Citi on the international trading desk. Interesting fact about Dana, before getting into the financial services business, he was a professional basketball player in both the ABA and Germany. So that's a surprise.
There you go. Didn't see that coming, did you?
And as of right now, literally right now, he's in the process of moving to Jackson with his significant other, and they are, I think, closing on their house next week.
I'm really hoping Pete is telling me that rates are going down in a week. So
yeah, we need mortgage. Yeah, we need rates to go down.
Week. That would be nice.
Don't count on it.
Yeah, perfect.
Yeah. So, all right. So here we are. So Gabrielle, I'm going to start with you. So.
Deal.
All right. Fair enough. So if you could share, I guess, broad market perspectives, your outlook on the big things, the things we hear about all the time, the economy, GDP, unemployment, inflation, the big picture stuff that's on the news that we all are worried about, and then we can maybe connect that to our view of the world and equity markets and and in 5 to 7 minutes. So, okay.
Easy task.
All right.
Thank
So we
you.
gotta get it
Thank
going.
you, Dave. And first off, just a huge thank you for the invitation, for bringing me here. It's my first time in Mississippi. Thank you. And I'm just very impressed with how genuinely warm and kind everyone is. So keep that in mind during Q&A. In terms of the outlook, I think it's been, certainly as people, as economists, as investors, it's felt like this roller coaster for the past 4 years, which feels like 40 years at this point. And certainly the economy has gone through a huge roller coaster, from everyone being shut down at home to buying tons of stuff. We couldn't get the stuff, and then we all went out and traveled and went out to eat. Meanwhile, prices of everything went up, interest rates went up, 500 basis points. It's been just quite a journey. What we see for this year is the first step towards something closer to normal that we took last year. We expect to continue this year when it comes to the economy. And really, we think it's kind of the last leg of a return to something more normal for the economy. And what do we really mean by normal? What do we mean by that? Well, fortunately, actually, our main economic forecast for the year fit nicely with the year 2024. 2% economic growth or GDP growth, 0 recessions in our base case or our most likely scenario, 2% inflation again by the end of the year, and an unemployment rate below 4%. So honestly, it's not quite a bad outlook. Actually, it's quite good. And last year, we kept hearing ad nauseum these metaphors, right, about the plane. Is it a hard landing, a soft landing, a no landing? Oh, now maybe the plane's not even in the air anymore. Oh my gosh, I hope we retire that at some point. But ultimately, what we're describing is very much in line with a soft landing, a return to more normal rate of growth, but a very strong, a good one, and inflation coming back to normal. Now, it's certainly not a smooth air all the time, and it doesn't mean every single part of the economy or part of the country is doing as well or having similar issues, but at a national level, 2024 is our outlook. In terms of economic growth, really, as usual, the main driver, us, consumers, 70%, still really the main reason that we feel optimistic about the outlook. I think a lot of us or others have spent a lot of those fiscal stimulus, all that pent-up savings that we had right after the pandemic. People have taken on a bit more credit card debt, but we still have a really powerful extra gas going for us, which is that the jobs market is still quite strong and actually historically strong, with the unemployment rate below 4% for over 2 years now. That's the longest really since the 60s. And finally, wages are growing a bit faster than inflation. So that's enough to keep that motor going of the consumer, but just maybe spending a little bit less above average, especially on services, kind of normalizing some of those trips and some of those entertainment spending. In terms of inflation, just quickly, saying back to normal 2% at the end of the year is a bit, at times, controversial, and it's not a straight line. But we really have seen a lot of normalization in a lot of prices, especially of things, of goods, and really about 80% of the remaining inflation pressure, it's two things. It's housing, which is pretty important, but also auto insurance. If anyone has tried to get auto insurance, it's rising still at double digits. It's pretty bananas. But the reason that we think these two, they're not going to go back down, right? Prices are not going to contract, but grow a bit less quickly, is because we started to see, for example, new rents start to grow less quickly, and we've seen auto prices come down. So kind of we're fighting the last battle here. And certainly we do think the 500 basis points of rate hikes that we've had in a year and a half have helped as well. Lastly, Dave, and then of course we can get into the details, when it comes to the stock market, new all-time high today.
That deserves a round of applause.
Woo!
I think it's
Let's
good.
go.
Applause. Yeah, that's a
never
good
a
I'm a
bad
bond
guy.
guy.
That's right.
Yeah, that's except for Pete. He's a bond guy.
Just worth remembering that we have had a very wild ride, but which ended last year certainly with the market up 24%. So I think it speaks to a couple of things. First, artificial intelligence and the ability of the largest companies to already make tons of money from that. The so-called Magnificent Seven, rightfully so, were super magnificent. And then also, of course, companies' ability to cut costs and have great earnings. But we can touch on these a little bit further. I'll make
Awesome.
sure to save space for my
Absolutely.
colleagues.
No. Thank you very much, Gabby. So Pete,
Sure.
you manage bonds.
Yes.
Very different animal.
Yes.
But if you could carry forward some of those themes for
Okay.
us, connect the dots on like the big picture stuff in your world, interest rates, federal finances, real yields, what people are
Okay.
actually earning in fixed income, and what we think are the good opportunities that are presented in fixed income.
Okay, so I'm going to be more pessimistic because I'm a bond guy.
Classic.
So we have 34 trillion in public debt. 27 of it is in treasuries. The other 7 is Social Security. And it's growing at a predicted clip of about 1.5 to 1.7 trillion. It's trillion per year, as far as the eye can see. in that scenario, I don't see how prices stay stable, and they only increase at 2%. I still believe in the old school that inflation is a monetary phenomenon. The inflation that we saw 2 years ago during COVID was all supply side. There just weren't enough things, so things got bid up. That's broken. We have plenty of supply now, including energy, but the money printing has not stopped and doesn't seem to make any difference who's in the White House. They just keep going because they can. We haven't had a budget in 14 years. Okay? There's no way to run anything. So
That's how I run my budget.
yeah, exactly. That's our mine. So I think we're in a sort of euphoric period right now, and because money's flowing everywhere, but I think the economy is just like a Texas Hold'em poker table. At the end of the night, one guy ends up with all the money. And this is what's happening here, except you guys and us happen to be the one guy. All gets funneled back into the markets. So whatever Fed throws out via their fiscal policy gets grabbed by the top 1% and they buy stocks, real estate, and bonds. So we'll see inflated prices, I think, in securities. But as far as wages not rising at a time when we have 400,000 of baby boomers retiring. These are skilled people. These are not guys that sling hamburgers or greet you at Walmart. 400,000. So we're going to have a big shortage, so wages are going to outpace whatever inflation is, in my opinion. And when you have wages rising, and we're in a service economy, people have no choice but to pay them more, and that translates into higher prices for all of us. That's just how it's going to go until they stop printing. And I don't know when that's going to happen. So I think the 10-year, they're going to cut. They said they're going to cut today, right, yesterday in June. So they're going to do 25, 25, and 25. So the Fed funds will be at 4.75. I think at year end, the 10-year will be at where it is today. That's a high likelihood. And mortgage rates are going to stay between 6.5 and 7. So if they drop rates more, if they go to 3%, they drop the Fed funds, that will trigger a drop in the biggest component of the CPI, which is owner's equivalent rents. It will actually inflate prices because mortgages will be cheaper now, so you can buy more. Your cash flow is, you're paying less for the same house. But in the CPI, it will show up as drop in housing. And they know this, they can manipulate this. So they could easily say, we're going to go to 3, mortgage rates go to 5, now the owner's equivalent rate drops, and now inflation is back at 2. So it's very possible they'll do that. The observable price increases that we have to live with are not going to be that. And I don't think that's conspiracy. I think that's as we observed over the last few years. It's just how things are. As far as opportunities in the fixed income market, so the 10-year treasury right now, if you buy it with a current inflation rate of CPI of 3.1, if you buy the 10-year, after tax, you're getting negative real return. So it's up to you. Okay? So you have to look to other things. You have the things that provide additional risk premium over. See, I can be honest. This is great. I can be honest today. I'm not selling anything. I'm actually telling you what I think.
Sounds like I got an equity guys over here.
So you have to reach to other sectors, right? Corporate bonds are tight. Commercial mortgage-backed securities are wide for a reason. What's happening in the office space market is no good. Multifamily and multipurpose, those things are doing storage, mini storage, those are doing well. Office buildings are not, and those are the big hunks. Those are the ones that cost a lot of money. I don't know if you saw it in the papers last week, 2 weeks ago maybe. There was a building in Rosslyn, Virginia, right outside of DC. I mean, right in it. It traded for $100 million 5 years ago. It sold for $25 million. And the owners walked away. Rather than putting more equity into it, they said, we can't do this because we can't fill it. It's not going to flow any cash. We just don't have enough renters. So that has to clear itself. And one thing people say, oh, you can just repurpose that for housing in the inner cities. Well, you're going to have apartments in the middle that have no windows. So you can't really repurpose it. Maybe on the outside, and on the inside you build ice skating rinks. I don't know what, but it's not as easy as they say. So I would be I don't think rates are going to rise a lot more. Like I said, there's a natural bid. The Fed's going to, the Treasury's going to issue, and the Fed's going to, I think the Fed has to fight them. Powell said that on 60 Minutes, said the fiscal policy is not sustainable. And one thing he can do, while the Treasury is throwing a lot of money and creating a lot of debt, one thing he can do, he can keep the price of money higher. And that's via not buying any more Treasuries from them, right? They have to place it in the market. And then he could keep the price of money high at 5%, 5.5%. Do I have another minute?
You have 1 more minute, yeah.
Okay. Apropos the debt, $8 trillion has to be rolled over this year. Most of it is maturities, we know that. But all of it is in 1 year and less in maturity. So it's old Treasury bills and notes that were 1 year and they're getting ready to mature. So they have this huge bubble up front, the US Treasury, $8 trillion, they have to place it back in the market. And most likely they'll place it with money market funds because rates are attractive in the front part of the term structure, 1 year and less. And they're going to issue more and add to it. So they're going to skew the amount of debt that the U.S. Treasury has to all up front. And if the Fed doesn't drop it, they're going to be in real trouble. The annual service to service the debt is already over $1 trillion. That's more than the defense budget. That's more than any Social Security payments or anything else. So it's becoming a problem that can no longer be ignored, I think. And the quickest way to get rid of all debt is inflate the value of the dollar. And that's what I'm scared of. I was born in Poland. I grew up, we left when I was 16. We left literally, middle of the night. I saw my grandfather lose everything he had. And I saw stores where I go into a store and all there was on the shelf was vinegar overnight. You had to stay in the brand line, and I did that. So I know what printing money creates. Maybe we're not there yet here, but if we don't watch out, we're gonna be.
All right, so a little contrast in...
A little better contrast, sorry.
Yeah. So what I will say before I turn it over to Dana, which, listen, as a bond manager, Pete is a lender of people's money, right?
My job is to keep you rich. You're already rich.
My job is to keep you wealthy, right? A lender of your money. So if your bond manager is overly enthusiastic and super rah-rah, you got a problem, right? So I think that's a good balance. So
I'm always pessimistic, yes.
That's his job, right? So don't
Literally
take that the wrong
every
way.
knife and fork stopped when he was right by the end there.
All right, we got to keep you paying attention. All right, so Dana, that's a tricky segue for you,
Yeah,
right?
one.
So
Thank you, Peter.
in your role at Wallach Beth, you work with asset managers like JP Morgan, like Curacent, like our sponsors, as I said before, right? So can you share with us some insights on how the asset management industry is responding to these factors that we're talking about in markets and sort of what that looks like relative to everybody in the room, right? And so let me give you, and I want one primer, because we throw around this acronym ETF, which I'm pretty certain that most of the financial professors in the room don't, but we talk about ETFs a lot. Could you just give us a quick primer on what ETF stands for?
Sure. Also, Peter made me feel much better about leaving New York City. I feel good about that now. So ETF, exchange traded funds, they've been around since 1993 when SPY came out. So ETFs originally were invented as a way for investors to get access to certain market classes that they didn't necessarily have access to. So the first country funds, for example, were invented by BGI before that iShares bought them, so that a pension plan could have expression to international markets that they really couldn't access unless they had specific SMAs created for them. So it was a cheaper way and kind of democratized the entire marketplace. So with ETFs, they've just kind of grown now over the years to kind of where we are now. They've kind of adapted with the marketplace. They've, through regulation changes, through different investment landscape changes, they've grown over to $7 trillion now, just U.S., and then there's over 3,000 products just in the U.S. At Wallach Beth, what we focus on is trading. So I'm just going to preface this. I'm not a market expert like these two. I'm a market structure expert. Know trading really well, and the main goal of our job is getting people comfortable with how they're expressing those viewpoints, and whether that's through buying stocks, buying ETFs, buying options, hedging their portfolio. basically working with groups like these two and then folks in this room, it's just bringing the importance of trading to how you're expressing that viewpoint, whether it's through international fixed income, a short position, a long position, any of those types of things. It's just taking trading into account, because what you're having is, say you're buying a treasury bond or a treasury ETF, your price matters. You're trying to collect only a certain amount of basis points. If you're losing those basis points in the trading, what's the point? What are we doing here? You're already, paying negative for buying certain things. And so for us, it's important to, have people kind of understand exactly what they're buying, exactly what they're selling. And that's kind of, Wallach Beth was created back in 2008. I joined in 2009. The whole purpose and ethos of our business is to get clients in and out of ETFs originally as efficiently as possible. And so when they first came out, they traded on exchange, just like a mutual fund. But the spreads were super, super wide. We were saving clients literally 25 cents a share when they were doing large blocks, million share blocks and stuff like that. And so what we did was just, capture those spreads, brought that back to the investor, and created a business out of it. But I think, for the purpose of this conversation, I can give you my predictions on where things are going. I don't think you want to hear them. I'm curious what you're going to say, but I think it's important just for this room to understand kind of ETFs are here. They can be a tool in your portfolio for a lot of different reasons, whether it's getting beta exposure to the S&P or it's getting international exposure or hedge exposure through some of the option-based products, or now you have Bitcoin, ETFs that are out there. It is the best time right now to be an investor as far as the efficiency is of the marketplace. And that is because you have just so many different products out there that are trading in extremely tight and difficult markets that you can get access to. We get clients that complain to us when they're buying bank loan ETFs, and we show them up a penny from the spread that's on the screen, and they call and complain. They're like, why didn't you get it done in the offer? And we're like, do you know how difficult it is to source bank loans? Like if you were just doing this yourself. And so I think it's just, the way that we work with our clients and the way that I kind of see this conversation going is just understanding the nuances of the products, understanding how they can fit in your portfolio, understanding how they can, use those, and then kind of why and where they've grown. But I'll kind of pass it back on that just to start it that way.
That's awesome. And I would, Gabriella mentioned AI and technology and how important that is. I think part of one of the reasons we wanted Dana to make some comments is this industry, while we talk about stocks and bonds, and we have since the first one of these 20 years ago, the way you all have access to them, when I say you all, I don't mean just the financial advisory community here. I mean the people and the investors in the audience. You're benefiting from that in a way that's important, right? You're getting better access for lower costs in a highly efficient way. And I think your point about it's a great time to be an investor. The way we have access to markets today is pretty extraordinary, and it connects back to a lot of that. So
yeah, that's it. It's you have mutual funds, you have SMAs, you've got ETFs, but ETFs are not replacing mutual funds by any means. They're not replacing SMAs, but people are using them for various reasons, and just having that understanding is so important. You've got groups like JP Morgan that have their own ETFs, and if you hear Jamie Dimon speak, ETFs are the future. They've done conversions, they've done clones of some of the mutual funds they have. It just gives investors access to this market in various venues.
We have a colleague that likes to use the phrase cup or cone, right? So you want it in a cup, you want it in a cone, whatever makes the most sense for you. You get in the car, you might take the cone so you can drive with the other hand, whatever logic you want to go with there. But anyway, all right, awesome. Thank you for that. So, Gabriella, I had a couple questions that I wrote down when you were speaking. So, and don't forget to write down your questions because we're getting to the audience next. So you kind of gave us the base case of 2024 and what that means. Pete talked about some pretty significant risks, so I'm going on a limb to talk about more risks. But what are the risks that we think about or you think about for that base case scenario?
Yeah, and I think there's actually not as much difference, perhaps, as it might have seemed between us, in the sense that we do think, just on a comparison to last year, and given where we are right now, that inflation can come back to 2%. But when we look out the next 5-10 years, we think this is a very different one than the last 5-10, when it was all about there's no inflation, it's always below 2%. Now we're expecting to go through a period where we do have these inflation surprises, inflation shocks, and periods where it normalizes again. So over the next 10 years, we do these super long-term forecasts as well, and we estimate an average inflation rate of 2.5. So it is above. That means there are moments where it's even higher than that. And the risk is certainly that it doesn't come down at all this year. But the bigger risk is that you do have spikes in inflation related to the fiscal situation, to geopolitics, to supply chain issues, and we can add a few others. And I think in terms of what to do about this, I think in terms of bonds, we were used to them being the diversifier for risks, and they can still work when the risk is recession or some kind of growth shock. But if the risk is pockets of inflation surprise, then we need other stuff to help us out. And that's where we think a lot about your classic inflation diversifiers. I'm from Brazil. We know fiscal spending and inflation ourselves, and sadly. And really what tends to work are a couple of things, right? So real assets, things for which the prices tend to go up, like real estate, like infrastructure. So a way that private markets or alternatives, quote unquote, can help to offset that risk. And another one is just equities. They're a nominal asset, right? Earnings of a company are based on how much stuff you sell and at what price. And if you're able to increase the price without sacrificing too much or at all on the actual volume of stuff, and you can control your costs, then that's not too shabby, actually. It actually is a slightly better environment. It's just one where not every single company is going to be able to have that good mix. And I think that's why we're seeing a lot more of the active conversation, whether it's ETFs or mutual funds, come to the forefront, because not everybody can deal with inflation quite as well. And the last risk, we would agree with the fiscal one too. It's a serious problem that doesn't seem to be addressed. And for us, I think the risk is us all trying to figure out what the right premium or the right reward is for taking on all those trillions in debt. And for us, we think when the 10-year was at 5%, maybe it was a bit too much. There's still a decent amount of demand. We think 4 makes a bit more sense. Like that's enough to compensate, but it's not going back to that, 10-year world where we were at 2%, 1%. So I'm sorry, Dana, for the mortgage bet. Or actually for me, because I missed out as well. So.
So I'm going to hesitate to do this, but Pete, I have a segue question on this relative to inflation. So we just saw some inflationary numbers in January, right? And so the question, I guess, then is that a trend or is that a blip? Like what do you see behind that, and do you see that persisting, or is that some of that volatility that I think Gabby was alluding to?
So I got into this business in '92, and for a long time, inflation was around 4 or 5%. So for me, that was the state of the union then. The 10-year was at 7.5, and inflation was at 5. You actually captured 2.5 for real yield. Made sense to do this. And they got eroded, and then we have a whole generation of new investors that finished college when the zero interest rate policy was enacted and was enforced until 2 years ago. So they don't know anything better. I'm not saying they're young and stupid. They're just young and unexperienced. So we could be at 3-4% inflation. Rates are going to have to go up a little bit, but that causes a big headache for the U.S. Treasury. Sure. And something else. Previously, when there was almost no money in Treasury bills and all the debt was out in maturities, and the Federal Reserve held most of it, they don't get to keep that coupon. They send it back to U.S. Treasury every 2 weeks. That's the law. So, in essence, the U.S. Treasury was funding $7 trillion worth of debt at zero interest cost. When you get out of the 5 and 10-year part of the market and you do it all in T-bills that's sitting in money markets, they actually have to pay it out. They do get to tax it, but they actually pay it out. That is part of the reason why the total interest expense for the year went up to over $1 trillion. And they are going to run out of money at some point. I guess you can always print, right? And then we know if you're paying debt with more debt and then with more debt, eventually you have to recognize that you cannot pay the debt anymore, and the currency gets devalued, and you have no happy times. But that is on my whole spectrum. That is like 10% of probability, maybe less. Hopefully they'll come to the census. They haven't so far.
A little more wine and everybody's fine with that, don't we?
Yes.
Yes. All right, so that does lend itself to something I'm not going to ask about, but it sounds like there's a tax implication in there somewhere, but that's probably not for tonight. That's probably another discussion.
Always is. You have to look at it. It's a real cost. I mean, you don't actually get it, right? Unless well, after being retired for 2 years, and then my wife told me that my retirement time was over, I had to go back to work. I didn't know this, but I discovered this year, 94,000 of capital gains is actually tax-free. So if I was advising people, and like my family and others, I would tell them, maybe don't reach out for the extra spread on your fixed income portfolios. I'm talking against my book now. Maybe you have a little more of equities, and then you sell some of the gains and generate your income that way, because it's actually very tax effective to do, at least portion of it.
All right, that's a thought. Some notes on that. Maybe I should take some notes on that. All right. So you mentioned a whole generation of people in the world of ZIRP, right? Very low interest rates, which translated to markets being, pretty easy in theory, right?
They have been, yes.
Very easy. So
every time something happens, the Federal Reserve comes to rescue.
So I think I got a good segue out of that back to you, Dan.
All right.
So we're seeing a lot of growth in actively managed ETFs, or at least that's my perception. So tell me what you're experiencing, Wallach Beth, and how does that translate to the potential for, a more effective instrument in a not zero interest rate world?
Yeah, absolutely. So as a trading organization, we do like volatility. We do like chaos. We do like when things change. Right now, the majority of our clients are well invested and are just long. And so for us, we don't mind when there's movement, stuff like that. As far as the growth we've seen in actively managed, so I think last year there was like 21% of the new ETFs that were launched are actively managed. 20% were fixed income. In that you have this whole growth of new ETF issuers. So an issuer would be somebody like an iShares, a JP Morgan, a Vanguard. They are issuing an ETF. That's just kind of how we refer to them in the business. But the new issuers, so there were 60 new issuers last year. And these new issuers were anybody from a group like yours, a fixed income group like yours that is taking an SMA or a mutual fund and either cloning it, converting it, or just launching new product. And the majority of these groups that we've been working with that have been clients of ours are actually now launching these products. And it goes with like kind of where we are in this entire marketplace, where active management is now popular, and now they are just taking the product and kind of like mimicking that. So what we see from our side is groups like Capital Group. I think there's a gentleman from Dimensional here. These groups are coming into the ETF world and have been classically, mutual fund companies, or, for Dimensional's purposes, almost like a closed off thing. They now have $120 billion in their ETFs. And so they really come on in a strong way. But what it allows is, like folks in the room, people in their personal accounts, people with different investment structures to get access to, these larger asset managers. JP Morgan's a perfect example. And you can just log on your Schwab account, you can log on your TD account, and you can just buy access to the most premier asset managers, portfolio managers in the world, just at the click of the button. You can buy 10 shares. There you go. And so for us, it's amazing because not only have we seen this transition from registered investment advisors, mutual funds, institutions using ETFs as a way to express their views, now they're using it as a way of not only can they get access to, they can create their own product and then get further their access on the distribution side. They can make their, their product, their mutual funds are like, they got their own tax issues. With ETFs, there's different tax structures, and so they can kind of pull that into how they're structured, and so what you have is just performance differences between those. So I think they're not going to replace mutual funds in that sense, but I think what we'll continue to see is just either clones or conversions going forward. I think the conversions, like year to date last year, I think it was like 60 billion in conversions just of mutual funds to ETFs alone.
Wow.
So it is a significant number.
It's a good time to be an investor.
It is a good time to be an investor. I mean, and you can have these products come in. They trade super efficiently. They are typically less expensive. They're tax efficient, and you can get access to them basically on every platform that you're trading on.
Awesome.
Can I add to the ETF
Yeah,
story?
sure, yeah.
Why I also like ETFs. So my core bond fund charges 36 basis points. It's an active. If I wanted listed and ask for shelf space at Fidelity, which is very hard, they want 40 basis points. So it's very hard for me to provide a product that's affordable and have it available to people at Fidelity. With an ETF, even if they have an account at Fidelity, they can just go out and buy it in the market, through him or through themselves. So that's why I like it. It takes a lot of power away from the powerhouses because they control the market. And essentially, it all comes down to savings for investors. 40 basis points might not sound like a lot, but 40 basis points on $1 million is quite a bit. So I think the whole market is going to shift. As soon as we can, we're probably going to move our funds from the mutual fund platform to ETF platform.
Give me a call.
Yeah. So I have a bunch of questions, but Andrew, I can see you in the back, and I think you got some note cards. So I could go on. We could do this for a long time. So let's take a break from my questions now. And Andrew,
Okay.
do you have a microphone, or do you need one, or am I going to read them?
Yes, you are.
Yes, I'm going to read them.
If
Okay.
you want to give a question, read them and do them in your order if you wish.
Okay.
You got another one?
All right. Actually, why don't I do our let me read these, Andrew, and I'll do our projections right now. How does that sound? Can we do our? All right. So I'm putting you guys on the spot. I mentioned it before. So every year, for those of you who've been here before, every year we ask our panel of experts to make their projections for the S&P and the 10-year Treasury at the end of this year, so at the end of 2024. Track record has been okay, I guess, over the past year. So I have last year's numbers. So last year, the S&P ended up 24%, 4,760. It's a pretty good year in the markets. The estimates we had from the experts were 4,475, which is 17%, 4,150, and 4,400, 8 and 15% respectively. So conservative crew last year. Let's start there. Let's take your projections for the S&P at the end of the year. Today, it sits at 587, an all-time high.
Pass.
Or sorry, you're going to pass. It's not 587, 5,087 today.
I'm not gonna.
You're not guessing?
You don't
All
want
right.
it. Yeah. 6,001. Yeah.
Pete, you got to go in for something.
7,000.
7,000. Wow.
Love this guy.
Gabby? 7,000.
That's exciting.
I know I can predict one thing with certainty, that whatever I predict will be wrong.
Okay.
You can.
Fair enough.
You can price and write this. This is an opportunity here.
I agree. I mean, these kind of price level forecasts are impossible. They're impossible.
I'm saying that all the debt that gets created at the federal level gets funneled back into the stock market. That's what I'm saying.
Fair enough.
Oh,
You're on the spot.
The
What do you
direction's
got?
up. So to be clear, this is not a JP Morgan Asset Management forecast, okay? Because we at Asset Management do not publish them because year by year it's all about sentiment, it's all about feeling. But my personal Gabriella forecast would be higher, would be 5,200. I think earnings are resilient. I think there's still a lot of excitement and delivery on the AI front, and a lot of companies that haven't participated yet
Can I get some of that?
that can. I don't know if I'm supposed to be explaining my
That's
guesses.
perfect.
but-
That's absolutely perfect. All right, so I'm going to segue. I'm going to do a couple questions, and then we'll come back to the 10-year. Okay, so you guys are welcome to chime in this one. I'm going to start with Gabrielle on this one because I know this is Actually, no, it says for you. It says for Gabby.
Oh,
Okay.
thank
So,
you.
China. How do you feel about China real estate, demographics, belligerence to their neighbors? How will that affect certain industries and specifically industries in the U.S. as well? So that's a big question. So,
That is a big question and certainly a very important question. Because I think what perhaps some of us forgot and were reminded a few years ago, and then especially in early 2021, is China is not a capitalist economy, has no interest in being one. They always called themselves a socialism with Chinese characteristics economy, which means like capitalism when it suits us, right? And every few years, there's always a change in the model based on where they are and who's in charge. And Xi Jinping's in charge, and he left it quite clear in early 21 with the new 5-year plan that now it's not just about growth, it's about a whole other bunch of stuff. It's about reducing inequality, it's about flexing your muscles globally, it's about prioritizing new industries, it's about staying in power. And it's not just that China that's gonna pump out growth, welcome foreign investment to help them get there. There's a bunch of different competing priorities. And I think ultimately what that means is not just American companies, but multinational companies have certainly woken up to that and the need to diversify where they produce things, right? It can't just be in one place called China. It has to be in a variety of different places, including the US, but companies moving new production to Vietnam, to India, to Mexico, that's booming, to diversify that. And I think more and more we're gonna hear about companies diversifying consumers as well. They're gonna wanna be in China for the 200 million Chinese joining the middle class, but Apple, for example, can't have a quarter of its revenues from China, right? Companies need to find new markets as well. And then lastly, I think it's certainly impacting already our decisions and within the US as well to try to diversify the risk that this goes from just being, rhetoric and some of these economic issues to actually something more like a real economic hot war or a military war. And here, of course, comes to mind Taiwan and our dependency on them for semiconductors. And hence, we got the CHIPS Act to start producing some of these semiconductors at home, and I think we'll certainly hear a lot more about it. So a very big change in the landscape. Doesn't mean, we don't look at certain opportunities in China, but I think we can think about some of these other beneficiaries from that change in mindset.
awesome. So we'll go to you, Pete, next, but before I do, there's about 12 awesome questions here, and unless you all want to stay till like 10, we're not going to get to them all. So what I did promise to Andrew is that if there's a question here that we don't get to, he'll give you my email address, and we will track down from our experts or from other sources answers to your questions, and he will pump them out. And because you all know it, you all are connected, you all know Andrew we will get you the answers. But I don't think at least unless they're pouring more wine that y'all are going to want to be here till 10. So, okay. So we talked about U.S. not addressing its debt issues. And I know this is you're not trading the rest of the world, but who is China, is Europe, are other developing countries? They all seem to have excessive debt, right?
They do. The whole globe does. Nobody is.
And
really.
so who's going to be the winner?
The only one that's fiscally responsible right now that I can think of are the Scandinavian countries and Switzerland.
Okay.
That's it. Everybody else is printing.
So who comes out the winner? Is that
Who comes out the winner? Well, the everyday man that's saving money in his savings account, he's going to be the loser, as they always are. If the world ever catches on fire, and I don't mean literal, I mean just economic troubles, I would stay domestically, because at least, states still have some sovereignty. And I'm not saying you invest locally, but why not?
Sure.
Why not start a business, sponsor a few businesses that are local? That's equity. It's not liquid, but at least you have some input into what's going on. I think that this country is still going to be the winner. I think we're going to shake this out. I think
That's super positive.
gonna go
I'm cutting you-
personal.
I'm
I think
cutting you
this
off there.
country-
You get
Super
the
positive.
positivity
That's
out
it.
of them. That's good.
Yep.
Just gonna
Yeah.
minute. That's it. We got it.
good.
Cool. Okay. So there's a whole bunch of questions on artificial intelligence, which we could spend a ton of time on. But Pete, Dana, I just want to ask you, in your world, and this is unfair because I didn't ask you to prepare for this
That's
question.
fine, yeah.
Has artificial impacted impacted your world and the trading side of the business? Because it sounds like technology's impacting your world a lot.
Yeah, it has, and I think it will. You think about traders back in the 70s, 80s, 90s, early 2000s, they all were trading in pits on the floor, looked just like this, just everybody yelling and seemed like they were drinking a lot more wine. Now you look at the traders of today, they all can code. Everything, a lot of it is automated. And so it's just changed. Technology has changed a lot of it. Everything's upstairs. Our organization's 55 people. If we launched our business 20 years ago, it would probably be 400 people, just because of the efficiency of everything. And so I think everybody sees artificial intelligence, it's going to affect us all in some way. I think you just have to understand your business, how to utilize it, how to use it, how to access it, embrace it, and then you just kind of adapt to it. I don't think it's necessarily, it's coming to change things, but I think if you view your business and kind of your investments, and this is how we view our business and kind of our trading, is no, we want to embrace how this is and how do we access this so it's better experience not only for us but also for our clients. So I certainly do see it. It's crazy how quickly that has changed, but again, it's all been more efficient markets. It's all been better for the end investor and kind of the overall experience with everything.
All right, so since we had a bunch on AI, I want to just, I'll shift this quickly to you because we all think of, and I think speak for myself, AI is sort of, how do we figure out who's going to win in AI, right? What AI companies are important. But I think what you just said is AI is important in your company, right?
Yep.
And AI is important in our company, right? And I'm sure it is for you as well. So
We just did an SEC. We just got hit with an SEC exam. We responded using AI, then we sent it to a lawyer, and there were 3 marks on the whole thing.
wow,
Wow,
that's amazing.
isn't it?
Yeah. So I think my take on this, and the reason I'm just not getting more into the questions is there's a lot to this, but it affects your business, our business, right? And I think that's the important take. So maybe Gabby just want to add a little to that.
Yeah, just the only quick thing to add to that is, the most important company on the planet, NVIDIA, reported yesterday that makes all those advanced semiconductors you need to process all of this data with artificial intelligence. And they made $22 billion in 1 quarter. And what they're saying is it's not just, companies like Microsoft and Meta investing in semiconductors, but they also pointed out finance, healthcare, and car companies. So basically, it's just the beginning of every single company, every single individual needing to kind of learn how to integrate it or be left behind. And I think we sometimes mix it up. It's really the power of artificial intelligence plus automation, which are slightly different things, but together can be very powerful to save us a bunch of time on SEC paperwork and other more mundane tasks and focus on other things, all at the same time cutting costs.
Awesome. Okay, so I'm going to shift back to our prognostication. We're kind of running up against the clock here. Andrew's tapping his wristwatch in the back, which I know what that means. All right, so predictions. You going to pass again?
I'm going to pass.
All right,
yeah.
Pete, 10-year, last year, the predictions were actually, just to say, the 10-year ended last year at 386. Projections were 351, 350, and 3. Today we sit at 433. So they were wrong, and we're even further from that now. So what's your take for the end of the
485 and a current coupon mortgage rate at 6.5
485, 6.5?
or 6.
All right, we haven't had that in the mix before, Andrew, but we're adding it. Current mortgage
People are
rate.
interested in their mortgage. Everybody wants to
All right.
refinance now.
Gabby, to you.
So we ended last year at 386. I don't think we go below that this year, unless when eventually we get a recession, we can dip below that. But otherwise, steady Eddie, we don't think we go much from 375 to 4 is kind of the end state.
Pick a number.
Fine. God. All right. Let's go with last year, 385.
385. Okay.
You want mine just to have?
Yeah, sure.
Can I just go 1 point higher than him?
Yep, take the over. Just taking the over? Okay,
Yeah.
we got you. All right. Look, I have gotten the hook officially from the back of the room. Thank you to all of you. It's awesome to sit up here and see such an amazing crowd. We really appreciate you. Thank you, Gabby. Thank you, Pete. Thank you, Dana. Thank you, Andrew. I hope you're breathing a little bit easy. Safe travels home, everyone. Great to see you.
Thank you.
Thanks.